Folks, I need to talk to you about something that's been keeping me awake at night. And at 95 years old, I don't lose sleep easily. Right now, as I'm speaking to you, the S&P 500 is trading at a Shiller PE ratio of 38. That's the third highest level in 154 years of market history. The only times it's been higher were 1,929, right before the Great Depression, and 2000, right before the dot-com crash that wiped out $8 trillion in wealth. Berkshire Hathaway is sitting on $325 billion in cash and short-term securities. That's not because we're feeling optimistic. That's because we can't find anything worth buying at these prices. And when I can't find value after 70 years of doing this, you should be worried. Very worried. Because what's coming in 2026 isn't just a correction. It's going to be a reckoning that makes 2008 look like a dress rehearsal. Let me be crystal clear about something before we go any further. I'm not a market timer. I've said for decades that trying to predict short-term market movements is a fool's errand. But I also know what overvaluation looks like. I know what speculative excess looks like. I know what bubble psychology looks like. And right now, in late 2025, every single warning sign is flashing red. This isn't about timing the exact top. This is about recognizing when risk has become so lopsided that the prudent thing to do is step back and protect your capital. Let me walk you through some numbers that should make any rational person deeply uncomfortable. The S&P 500 is trading at 38 times cyclically adjusted earnings. To put that in perspective, the long-term average is around 17. We're trading at more than double the historical norm, but it gets worse. Market capitalization to GDP, what I call the Buffett indicator, is sitting at 210%. That means the total value of all U.S. stocks is more than twice the size of the entire American economy. The only time this ratio was higher was in late 1999 and early 2000, right before the tech bubble burst. Back then, the ratio hit 150%, and we thought that was insane. Today, we're at 210%, and people think everything's fine. Corporate profit margins are at record highs, around 15%. That's wonderful, except margins are one of the most mean reverting series in finance. When they're this elevated, they always, and I mean always, come back down. Competition intensifies. Labor costs rise. Pricing power erodes. It's happened in every single cycle I've witnessed over 7 decades. The concentration risk is staggering. The top 10 stocks in the S&P 500 now represent 40% of the index's total weight. Just 10 companies. At the peak of the dot-com bubble, the top 10 represented 27%. We're beyond dot-com levels of concentration. If those 10 stocks stumble, they don't just drag down the technology sector. They take the entire market with them. And here's the really scary part. Retail investors have piled into the market like never before. Margin debt, money that investors have borrowed to buy stocks, recently hit $750 billion. Every time margin debt has spiked to these levels in the past, a crash has followed within 12 to 18 months. Why? Because when markets turn, these leveraged investors get margin calls. They're forced to sell regardless of price. That forced selling creates more downward pressure, triggering more margin calls, creating a vicious cycle that accelerates the crash. What really concerns me isn't just the valuations, it's the psychology. I've been through enough market cycles to recognize the warning signs of bubble thinking. And right now, that thinking is everywhere. First, there's the new paradigm narrative. People are saying this time is different because of artificial intelligence, because of technological innovation, because of Federal Reserve support, because of whatever rationalization helps them sleep at night. But I've heard this time is different in every bubble I've lived through. It was different in the 60s with the Nifty 50 stocks. It was different in the late 70s with oil and commodities. It was different in 1999 with the internet. It was different in 2007 with housing. It's never different. The fundamentals of value and price haven't changed in 200 years of market history. Second, there's the fear of missing out that's driving behavior. People aren't buying stocks because they've analyzed the businesses and concluded they're undervalued. They're buying because Stocks went up last year and the year before and the year before that. They're terrified of being left behind. That's not investing. That's herd behavior. And herds have a nasty habit of running off cliffs together. Third, there's the dismissal of skeptics. When Charlie Munger and I raised concerns about valuations back in 2021, 2022, we were told we were too old, too conservative, too stuck in the old ways. We didn't understand technology. We didn't understand the new economy. It's the same thing we heard in 1999. It's what every bubble skeptic hears. The crowd doesn't want to hear warnings when everyone's making money. They want confirmation that the party will continue forever. Fourth, there's the retail investor mania. We're seeing unprecedented levels of options trading by retail investors. The number of zero-day options contracts has exploded. These are essentially lottery tickets, pure gambling on short-term price movements. When regular people are day trading options on their lunch breaks, you're not in a healthy market. You're in a casino, and the house always wins eventually. Let me talk specifically about what Wall Street is calling the Magnificent Seven. NVIDIA, Apple, Microsoft, Amazon, Alphabet, Meta, and Tesla. These 7 companies have driven the majority of market gains over the past few years. They represent about 32% of the S&P 500's total market cap. Are these good companies? Most of them, yes. Are they worth their current valuations? That's where I have serious doubts. NVIDIA is trading at a market cap over $3 trillion. That's larger than the entire GDP of France. For a semiconductor company, yes, they're dominant in AI chips. Yes, demand is strong. But at these prices, everything has to go perfectly. No competition can emerge. No technological disruption can threaten their chips. Demand has to continue growing at unprecedented rates. That's a lot of things that all have to go right. Apple has a market cap around $3.5 trillion. That's wonderful. They make great products, but they're selling iPhones in a mature, saturated market. Their growth rates are slowing. At 30 times earnings for a company, growing revenue in the single digits, you're paying for perfection. And perfection is expensive, especially when it rarely materializes. The whole Magnificent Seven narrative is dangerous because it creates a false sense of safety. People think because these are quality companies, they can't fall. But quality and price are two different things. Cisco was a quality company in 2000. It had real revenue, real profits, real products. The stock still fell 86% from its peak. It took 24 years just to get back to its year 2000 high. Quality doesn't protect you if you overpay. Here's something that keeps me up at night. The amount of leverage in the system. I'm not just talking about margin debt, though that's concerning enough. I'm talking about corporate leverage, private equity leverage, and derivative exposure. Corporate debt in America is now over $11 trillion. That's up from $6 trillion before the 2008 financial crisis. Companies have borrowed heavily for years because interest rates were low. They use that debt to buy back stock, pay dividends, make acquisitions, but now, with interest rates higher and likely to stay elevated, that debt is becoming expensive to service. What happens when a recession hits? Because recessions always hit eventually. Companies with heavy debt loads face a choice: cut costs, which means layoffs, or default, which means bankruptcy. Either way, it's not good for the economy or stock prices. Private equity has over $2.5 trillion in dry powder, uncommitted capital. That sounds good until you realize they've been unable to deploy it because valuations are too high even for their aggressive return targets. When the professionals who are willing to use leverage and take risks think prices are too expensive, that should tell you something. The derivative market is even more concerning. The notional value of derivatives globally is over $600 trillion. Now, the actual at-risk amount is much smaller, but we've seen how derivative exposure can amplify problems. Remember long-term capital management in 1998? Remember AIG in 2008? Derivatives create hidden interconnections between financial institutions. When stress hits the system, those interconnections can transmit problems at lightning speed. Let me talk about the Federal Reserve because they're in an impossible position, and that impossibility is going to contribute to what's coming. Right now, inflation has moderated, but it's still above their 2% target. The economy is showing signs of slowing, but hasn't fallen into recession yet. Unemployment is low, but starting to tick up. What's the Fed supposed to do? If they cut rates aggressively to support the economy, they risk reigniting inflation. If they keep rates high to ensure inflation is truly defeated, they risk triggering a recession. There's no good option. They're threading a needle in a hurricane. And here's the problem for markets. Stock prices have been supported by the belief that the Fed will always step in to save the day. The Greenspan put, the Bernanke put, the Powell put, the idea that whenever markets get into trouble, the Fed will cut rates and rescue asset prices. But what if they can't this time? What if inflation concerns prevent them from cutting rates even as the economy weakens and stocks fall? We got a taste of this in 2022 when the Fed raised rates aggressively and stocks fell 25%. But then inflation started coming down and the market recovered, betting on rate cuts. Now we're in a situation where the Fed has limited ammunition. They can't cut rates to zero like they did in 2008 and 2020 without risking serious inflation problems. The safety net people are counting on might not be there. So what actually triggers the crash? That's the question everyone wants answered. And the truth is, I don't know exactly. Nobody does. But I can tell you what the likely candidates are. Catalyst 1, an economic recession. The odds of recession in 2026 are higher than most people realize. Leading economic indicators have been negative for months. The yield curve was inverted for an extended period, which has preceded every recession for the past 50 years. Corporate earnings are already under pressure. If we tip into recession, which I think is probable, earnings could fall 20 to 30%. And if earnings fall while valuations are already extreme, stock prices get crushed. Catalyst 2, a geopolitical shock. We're living in an increasingly unstable world. Tensions with China, conflict in the Middle East, the war in Ukraine. Any of these situations could escalate in ways that shock markets. I'm not predicting World War III, but I am saying geopolitical risk is elevated and markets are pricing in basically zero risk premium for it. Catalyst 3, a major corporate bankruptcy or fraud. In every bubble, leverage and fraud hide in the corners, unnoticed until it's too late. We saw Enron in 2001. We saw Lehman Brothers in 2008. Right now, with corporate debt at record levels and some companies barely generating enough cash to service that debt, we're one bankruptcy away from a crisis of confidence. When investors realize that accounting has been aggressive and debt loads are unsustainable, the selling can start fast. Catalyst 4, the AI spending bubble bursting. I've talked about this in other contexts, but it applies here too. Companies are spending hundreds of billions on AI infrastructure and the returns are uncertain at best. If companies start pulling back on that spending, if AI doesn't deliver the productivity gains everyone's betting on, the tech sector could crash hard. And with tech being 30% of the S&P 500, a tech crash is a market crash. Catalyst 5, a loss of confidence in the Magnificent Seven. These 7 stocks have driven so much of the market's gains that if even 2 or 3 of them stumble, the psychology changes. Imagine Apple's iPhone sales declining. Imagine Nvidia facing real competition from AMD or Intel. Imagine Tesla's margins compressing as competition in electric vehicles intensifies. Any of these could be the pin that pops the bubble. Let me take you back through history because the pattern is always the same. People forget the lessons. They convince themselves this time is different. Then they relearn the lesson the hard way. In 1929, the market was at all-time highs. People thought prosperity would last forever. Then came Black Tuesday. The Dow fell 89% over the next 3 years. It didn't recover to its 1,929 peak until 1954. 25 years of lost wealth. In 1973 and 1974, we had the Nifty 50 bubble. 50 stocks, blue chip companies like Coca-Cola, McDonald's, Disney, that were considered one decision stocks. Buy them and hold forever because they were so good they couldn't fail. The market fell 48%. Those wonderful companies saw their stock prices cut in half or more. In 2000, We had the dot-com bubble. The NASDAQ peaked at 5,048 inches March. By October 2002, it was at 1,114, a 78% crash. Companies with no revenue and no profits had been valued in the billions. Pets.com, Webvan, eToys, all gone. Even the survivors like Amazon and Cisco took years to recover. In 2007 and 2008, we had the housing bubble. Real estate always goes up, they said. You can't lose money in real estate, they said. The S&P 500 fell 57% from peak to trough. The financial system nearly collapsed. It took 5 years just to get back to break even. Every single time, the pattern was the same. Excessive valuation, widespread belief that this time is different. Dismissal of skeptics, retail investors piling in at the top, then a catalyst, then panic selling, then a crash that wipes out years of gains in months. Let me paint you a picture of what I think 2026 is going to look like. I don't know if it starts in January or June or October, but here's the sequence I expect. First, we'll see cracks appear. Maybe it's a disappointing earnings season where companies warn that growth is slowing. Maybe it's economic data that comes in weaker than expected. Maybe it's the Fed signaling they can't cut rates as much as markets hope. Whatever it is, confidence begins to erode. Second, the Magnificent Seven start underperforming. One or two of them report results that disappoint. Maybe Nvidia's growth rate decelerates. Maybe Apple's iPhone sales decline. The stocks don't crash immediately, they just stop going up. And when momentum stocks stop going up, momentum investors start selling. Third, market breadth deteriorates. The number of stocks making new highs shrinks. More stocks are falling than rising. The indices might still look okay because they're dominated by the big companies, but underneath, the market is weakening. Fourth, volatility spikes. The VIX, which measures expected volatility, has been abnormally low. Complacency is off the charts. When volatility erupts, as it always does, leveraged investors get hit with margin calls. Algorithmic trading programs kick in, accelerating the selling. Fifth, the cascade begins. What starts as a 5% pullback becomes 10%, then 15%. Panic sets in. Retail investors who've never experienced a real bear market hit the sell button. ETFs see massive outflows. Mutual funds have to sell to meet redemptions. The selling feeds on itself. Sixth, the bottom forms, but not quickly. This won't be a V-shaped recovery like 2020. That was a unique situation with a clear cause, a pandemic, and a clear solution. Massive fiscal and monetary stimulus. This time, the problems are structural. Overvaluation, excessive debt, economic weakness. The Fed limited in what it can do. I'd expect a decline of 40 to 50% from peak to trough, similar to 2008. And I'd expect it to take 12 to 18 months to fully play out. So what should you do with this information? Let me be specific because general advice doesn't help anyone. If you're heavily invested in stocks right now, you need to reassess your risk exposure. Ask yourself honestly, if the market falls 40%, can I handle it emotionally and financially? If the answer is no, you need to reduce risk now while you can still do it on your terms. I'm not saying sell everything and go to cash, but I am saying that having 20 to 30% of your portfolio in cash or short-term treasury bills makes a lot of sense right now. Those treasury bills are paying 4 to 5%, which is a real return after inflation. And when the market crashes, you'll have capital to deploy at much better prices. Avoid leverage completely. If you're using margin to buy stocks, stop immediately. Pay off that margin debt, even if you have to sell positions to do it. Leverage will destroy you in a downturn. I've seen it happen to smart people over and over. Don't let it happen to you. Focus on quality if you're going to stay invested. Companies with strong balance sheets, low debt, high free cash flow, and pricing power. These businesses will survive and eventually thrive. But even quality companies will get marked down in a crash. The difference is they'll recover. The speculative garbage won't. Avoid the most overvalued sectors. Technology is priced for perfection. Consumer discretionary is vulnerable to recession. Anything related to AI spending is risky. If you want exposure to these sectors, wait until after the crash when prices are reasonable. Consider defensive sectors: utilities, consumer staples, healthcare. These won't make you rich, but they won't destroy you either. In a bear market, not losing money is how you win. Build a shopping list of companies you'd love to own at reasonable prices, because when the crash comes, there will be incredible opportunities. Wonderful businesses will trade at fair or even cheap valuations for the first time in years. If you have cash and a shopping list, you'll be able to take advantage while everyone else is panicking. Now, some of you are thinking, but Warren, you've always said you can't time the market. You've said trying to predict short-term movements is futile. Now you're predicting a crash in 2026. Isn't that contradictory? Let me clarify. I'm not market timing in the sense of trying to pick the exact top or bottom. What I'm doing is risk management. When valuations are reasonable and the economy is healthy, you should be fully invested because the odds are in your favor. When valuations are extreme and risks are elevated, you should reduce exposure because the odds have shifted against you. Think of it like this. I'm not smart enough to know if the market will peak in February or July, but I am smart enough to recognize when we're in the late innings of a bubble. And right now, we're in the 9th inning with 2 outs. Maybe there's one more rally left. Maybe we get to 10 outs somehow. But the game is ending, and you don't want to be the person betting everything on extra innings. This isn't about being clever or outsmarting the market. It's about recognizing extreme situations and acting accordingly. In 1999, I recognized the dot-com bubble and stayed away from tech stocks. People said I was finished. Then the crash came and Berkshire looked pretty smart. In 2007, I recognized the housing bubble and avoided financial stocks loaded with subprime exposure. Then 2008 happened, and we survived while others didn't. I'm not predicting, I'm observing. And what I observe in late 2025 is a market that's priced for perfection, trading at valuations seen only twice before in history, both times before major crashes. That's not market timing. That's pattern recognition. Here's the good news, and yes, there is good news. Every crash creates opportunities. When markets panic, wonderful businesses get thrown out with the garbage. In 2008 and 2009, we bought billions of dollars worth of stocks and preferred shares in great companies at incredible prices. Goldman Sachs, Bank of America, Swiss Re. Those investments made Berkshire and our shareholders a fortune. The same thing will happen in 2026 and 2027. When the S&P 500 is down 40% and people are convinced the world is ending, that's when you'll be able to buy the best businesses in America at fair or even cheap prices. Companies that generate billions in cash flow, have strong competitive positions, and will be thriving in 10 years. They'll be on sale. But you can only take advantage of these opportunities if you have capital. If you're fully invested or leveraged, when the crash comes, you'll be forced to sell at the worst possible time. You'll lock in losses and miss the recovery. But if you have cash, if you've been patient and prudent, you'll be able to buy when others can't. That's how wealth is really built. Not by riding bubbles and hoping you get out in time, but by being disciplined enough to step back when things get frothy, preserve your capital, and deploy it aggressively when fear creates bargains. Buy when others are fearful and sell when others are greedy. That's not just a cute saying. It's how I've made money for 70 years. Some people will ask why I'm being so direct about this. After all, I usually couch my concerns in more diplomatic language. I talk about not finding opportunities at current prices rather than predicting crashes. So why am I being blunt now? Because at 95 years old, I've seen this movie too many times. I've watched too many people lose money they couldn't afford to lose. I've seen families destroyed by market crashes. I've watched young people have their financial futures devastated because they believe the hype. And I don't want to see it happen again, especially when the warning signs are so clear. I've made my money, Berkshire secure. I'm not trying to profit from this warning. I'm trying to help people avoid a disaster that I see coming as clearly as I've seen anything in my career. If that means being more direct than usual, so be it. I'd rather be criticized for being alarmist than stay quiet and watch millions of people get hurt. The stock market crash of 2026 is coming. The only question is when and how severe, but it's coming because every bubble ends, every period of extreme overvaluation corrects. Every time people say this time is different, it isn't. History doesn't repeat exactly, but it rhymes. And right now, it's rhyming with 1,929 and 2,000. Protect yourself, reduce risk, build cash, make a shopping list. And when the crash comes, be ready to take advantage of the opportunities it creates. That's how you survive bear markets. That's how you thrive in the long run. The choice is yours. But you've been warned.